We are diving straight into the extended term insurance option for the national portion of the life insurance exam, which is a critical component of the non-forfeiture options found in permanent life policies. When you are sitting for the exam, you need to recognize that non-forfeiture values are the legal protections that prevent a policy owner from losing their equity when a policy lapses due to non-payment of premiums. The extended term option is unique because it uses the accumulated cash value of the lapsed policy as a single premium to purchase a term insurance policy. The most important characteristic to remember for your test is that the face amount of this new term policy is exactly the same as the face amount of the original whole life policy. If a client had a $50,000 whole life policy and it lapsed, the extended term option would provide $50,000 of coverage for a specific period of time. This is a primary target for exam questions because they will often ask which non-forfeiture option provides the maximum amount of life insurance protection in the event of a lapse. The answer is always extended term because the other options like reduced paid-up result in a smaller death benefit. You should also be aware that the length of the term coverage is determined by two factors, which are the amount of cash value available and the insured's attained age at the time of the lapse. As you get older, the cost of insurance increases, so a specific amount of cash value will buy a shorter duration of coverage than it would for a younger individual. A major trap on the national exam involves the default status of these options. If a policy owner fails to select a non-forfeiture option within the grace period or the 60-day window following a lapse, the insurance company will automatically apply the extended term option. This is the standard default in the industry and is frequently tested to see if you know what happens when no choice is made. You might see a scenario where a policy owner forgets to pay their premium and dies a few months later. In that case, the insurer would pay the full face amount because the extended term option was automatically triggered. Let us look at how the exam might word a question about the transition from a whole life policy to extended term. They might describe a situation where a policy owner has a $100,000 policy with $20,000 of cash value. If they choose extended term, the exam wants you to know that the new policy is still for $100,000, and the $20,000 is simply the fuel that determines how many years and days that coverage lasts. You must be careful not to confuse this with the paid-up additions dividend option, which is a completely different concept. Non-forfeiture options like extended term only kick in when the policy is being surrendered or lapses. One way to keep this straight in your head is the phrase, save amount, longest time, which helps you remember that extended term keeps the same face amount but limits the time of coverage. Contrast this with reduced paid-up, where the time is for life but the amount is smaller. Another point of confusion on the exam is the relationship between the loan balance and the extended term option. If there is an outstanding policy loan when the policy lapses, the amount of that loan is usually subtracted from both the cash value and the face amount of the extended term insurance. This keeps the insurance company from being on the hook for more than the net value of the policy. When you see a question about a lapse with a loan, remember that the death benefit will be reduced by that loan amount even under the extended term option. Remember that once the cash value is used up to buy this term insurance, the policy has no more value and will eventually expire with nothing left for the policy owner. The exam may try to trick you by suggesting that extended term continues to build cash value, but that is false because it is now a term policy. Focus on the fact that extended term is about maximizing the death benefit for as long as the money allows, and it is the safety net that the state requires companies to provide. If you keep the face amount identical in your mind when you see the word extended, you will be able to navigate the trickiest questions on the national exam.